Guys, welcome back to another episode of Impractically Practical. We're here on one of our Real Talk segments. We're bringing Mr. Craig Gradowitz back. What's going on, Craig? How you doing?
Hey, I'm good. How are you?
No jokes on this machine today.
No more jokes?
Nah, not on this one. I got in trouble a couple times by Adrian. Won't be doing that anymore. What's up, Adrian?
Hey, can you hire my headset a little bit?
Of course I can.
Perfect.
You good?
A little lower.
Come on. All right. Pre-production stuff being done during production.
Maintenance.
Come on. So the big topic around town, well, around the United States, right? Or around the world. Is that a worldwide thing?
Probably.
Yeah.
The United States economy affects pretty much everybody. Yeah.
Silicon Valley Bank, right? That's what it's called.
It is.
So they had a failure. Some people calling it a bailout. What are you calling it, Craig?
No, I don't think it's a bailout. I think they, the Fed stepped in and purchased assets that the bank had that at the face value instead of the discounted market rate, basically. So, I mean, in a sense, to me, it's not a bailout. They just basically took their asset off. If Adrian had a house that he bought for $300,000, it's worth $200,000 today. I said, it's okay, Adrian, I'll pay $300,000 because one day I know it's going to be worth $300,000 again. And I didn't really necessarily bail him out. I just bought it for more than it's worth when he could sell it on the open market. So I wouldn't say bailout. But
now, what's the reason the Fed is doing that?
Well, I think they want to save the rest of the economy, and I think that's one positive thing I think we can all take from this is that they did step in and they did do what they did, because if they hadn't, then with that run on the bank, obviously that bank would be in trouble. People wouldn't get their money, and then all of a sudden it's going to happen everywhere else. Because the truth is, I mean, pretty much every bank in the country has a similar issue, meaning they all bought bonds at a lower rate, that those bonds now are not worth as much, and that's part of what they do for investing as a bank. So they all have a similar issue. But if you started a panic in the sense that that bank wasn't able to pay everybody, so that's going to roll out to every bank, it could have been a lot worse. So I think that clearly was the motivation.
So backtracking a little for the people that don't know what's going on, SVB.
Yeah.
Right. What is the 16th largest bank or something like that? 16th largest.
That I don't know.
In the nation.
It was pretty big,
yeah. Second biggest bank failure in the history, I believe.
Yeah.
And this was because of, like you said, buying bonds and just investing your money. So to my knowledge, and you can correct me if I'm wrong, a bank, the law is that they have to keep 10%, right? Or something like, maybe not law, but what the banks do
Liquid,
is,
yeah.
Yeah. So like deposits, let's say someone deposits $1 million, they have to keep $100,000 for deposits and withdrawals and stuff like that.
Right.
The rest, they have the right to invest it in pretty much whatever they want.
Pretty much, yeah. I mean, the concept would basically be, not everybody's going to need their money at one time, and that's kind of the 10%, theory there. And when something like this happens and multiple people do want their money all at once, especially larger ones, then, it can pose a problem. The theory basically would be that, even if the bank had that issue, they could just liquidate, their assets, and in this case, bonds or investments that they had. But if they go to do that and they can't get the money that they paid for them, then you start having a problem.
So this was triggered in a way by the Fed rate going up as well, right?
That's exactly what it was. Yeah, exactly. So the fact that the Fed hiked interest rates so quickly that those bonds now have a much higher coupon, that makes their return a lot worth a lot less. And so, I think my personal opinion is that the Feds, are the reason that this happened. And I'm hoping, I think there's a lot of people that also agree that could happen, that they wake up a little bit and start, calming down on the rate hikes, because again, that's what, got us here.
Yeah. So, Adrian, any thoughts, any comments?
Yeah, and I mean, so like from what I understand, right? And I know as well, initially, Janet Yellen, the Treasury Secretary, she said that they weren't going to be bailing them out, right? But of course, I think they had a change of heart, and I think the biggest thing to understand, or from what I understood, or just looking at a couple of videos, is that right, if they don't bail out like Silicon Valley, right, then this is going to create like kind of like a domino effect for the next couple banks. That because I think there's a list. There's like top 10, like of not top 10 banks, but there's a couple banks that are kind of in a similar position as far as like being like liquidated, right? Because now this is causing a lot of urgency for many other people and different businesses to now liquidate their money out of the banks, and going to cause a similar issue.
Yeah, no doubt. I think Yellen saying that on the face value is kind of like, hey, if this bank went out and did stupid things, we're not going to step in and try to help them. But really, that's not what happened. I mean, they did normal investments, what they normally did. Now, you can criticize what they did, of course, but the thing is that virtually every bank in the country has a similar issue.
Similar scenario, just maybe different places or
Right,
different allocations.
right, and it might not be as out of whack, if you will. It might not be as bad. They might not have that same problem that they have, but they all have a similar issue. They all invest in similar things, and those things are not worth what they were at that time. So I think once the Fed kind of realized, hey, you know what, this is what happened. We probably had a hand in this. They're going to say, hey, all we do is buy these bonds. We're going to be whole. I mean, the Fed's going to be whole on these bonds over time. It's just they're not going to be able to liquidate them quickly like the bank was at. So I think that it changed their mind from the initial just simply because it wasn't necessarily just all reckless.
Now, it was, so you, in your opinion at least, was it no irresponsibility at all? It was kind of just things happened how they happened?
I mean, I think it's always hard to see the future, right? I mean, me and you were talking this morning, Crystal Ball Award, they give that to people, that can do that, right? Or get as close as they can. And I think that what they did, you go off of data, you go off historic data, and when you follow that data and you're investing, I mean, could they have spread it out a little different? Sure. Could they have slowed things down? I'm certain that they could. But at the same time, if you relate this back into like an 07, 08 kind of thing, then you're questioning what you're investing in, because you're investing in all these mortgage bonds that were on adjustable rates and different things like that. And I think you could get a little deeper there. I think for this, you're buying treasuries.
Yeah.
It's kind of hard to say how reckless it was. At the same time, if you have better economists on your panel that say, hey, we got to be careful on these,
well, that's
certainly.
That's where I was going with that, where I read that they, as of April of 2022, didn't have a chief risk manager. I think that's what it's called.
Yeah.
And so what I assume a chief risk manager does is literally manage risk. So, hey, this is going to shit. Fed rate is going here, stuff like that. And they didn't have someone in place to do so. Yeah. And so I would assume a B of A, a Chase, banks like that, which are different kind of banks, if I'm not mistaken, right?
I don't know if they're different. They're certainly a lot bigger.
But I mean, like Chase can be from business to a day-to-day personal checking account.
Sure.
Silicon Valley was almost like 90% or something like that.
Catering to the big investor.
Exactly,
Yeah,
like millions and millions.
Sure.
Yeah, so of course Chase holds these big old accounts as well, but they're not like catering to them.
I'm probably going to get the exact percent wrong, but I read somewhere that they're 250,000 and under, right, that are federally insured accounts with something like 9% of their total deposits. So very little of consumers.
I heard that too. That the only 250 were back, but 90% of the people there were over 250.
Exactly. So in that case, you're right. They would be different, because someone like a B of A or Wells Fargo or something obviously has millions of customers that are smaller credit hold deposits.
Yeah. And so that's where my question originates. Where if you look back at everything that's going on and how it happened and how it didn't happen from one day to another. I guess they were also talking about how they just received an award or something like that.
Yeah, so they were on the Forbes list, I think, was it like a couple weeks ago, like saying that they were one of the top, banks and this, and they like retweeted it, said that they were, they were happy for the,
and then 2 weeks later, boom.
And then 2 weeks later, yeah.
Crazy, huh? And the reason for that, as I'm sure everybody probably knows by now, is because they are able, under the current regulations, to list the value of those investments at the face value that they purchased them at,
even if they're upside down.
Now. And so when some of these guys that are really good at shorting big companies figured that out and went, wait a minute, if you're listing this at X billion and it's really a lot less, that means that you might have some trouble. And when they start letting that word out to big investment firms that, hey, if you guys got money in there, you might want to think about it, it can happen that fast. And so I think that's pretty much what happened from the week to week and practically day to day.
Yeah, because I'm curious to see, I don't know if you can check, Adrian, how the amount of withdrawals that happened within a week. I think I was seeing that it was crazy.
Yeah, I don't know the amount, but
billions of dollars.
Yeah. Oh, for
Like,
sure.
crazy.
Oh, for sure. No, they had clients in the hundreds of millions in just one account. So it's like, once they start moving that out, it gets weird pretty fast.
Yeah, I also heard a lot of pretty much competitors reaching out to these people even weeks ago saying, hey, this is about to go down. Like, bring your money over here.
No, that is what happened, is that like I said, some of these guys that are really smart that track this kind of stuff could see that, and they start sharing that information with either their clients that are big clients or other firms. And then if you're shorting it, what do you want to do? You want to feed in some negative information. So they feed out the negative information, and it starts to run its course, and then they get paid on that. So,
Yeah.
Well, what do you guys think? Or I guess so. Like 2 or 3 weeks prior, on February 27th, that the bank CEO, they actually sold 3.6
Yeah, they
million
did.
in shares. So
Yeah.
I
That
mean,
happened-
They obviously foreshadowed it. They
That
foreseen
happened
coming.
the same week that they got this award and shared all kinds of stuff about them doing crazy
I
good.
know, I saw that too, and I just had to laugh because, I mean, let's just face it. I mean, that pretty much happens every time, right?
Yeah.
I mean,
Yeah.
the captain doesn't always go down with the ship.
You're supposed to.
They're supposed to.
You go down with your ship? Will you go down with your ship?
I always do. I'm down right now.
So one of the biggest questions that the reason that we're doing this for is we obviously cater to our local, our local people and mortgages and real estate. So a real answer, not a biased nor optimistic answer. What do you think this is going to do to mortgage rates and to real estate in general, at least at the local level? I don't care about nationwide. We live in Kern County. Let's talk about Kern County.
I honestly think, if anything, it's helpful in terms of the rates. So if you follow the market, you saw yesterday we had a pretty good rally in interest rates, and that's because of this crash. Because when you, in simple terms, and I've always kind of said this to clients, in simple terms, bad economic news equals better rates, good economic news equals higher rates. And so when you have bad economic news, like a bank crashing, it can help in that sense. I think it also can help with the Fed's slowing down, and certainly slowing down rates obviously would help as well. I don't see us really being reached by this necessarily. It's a pretty far ripple effect to get that far into, your everyday guy that wants to buy a house or wants to sell a house. I don't see that necessarily happening. I think if anything, we get a little bit of a benefit that Feds may wake up and slow things down a little bit, and some negative economic news is not bad for interest rates. So
Yeah, because would you say that inflation directly affects mortgage rates more than the Fed rate?
Oh, for sure.
Yeah, right.
For sure. And the Fed rate is lagging behind, right? So when inflation's going up, the Fed's coming in behind them and trying to catch up. And so one of the things we fight as being in the lending industry is, talking to consumers that go, oh, I heard Fed's, raised again. It's like, well, yeah, we actually went down because they're kind of behind us a little bit. They're raising to catch up. But as the inflation starts to come down, which it has, then we see some of the benefit on our side.
So about 7 to 10 days ago, we were hearing, not even that long ago, about 7 days ago max, we were hearing that the Fed was thinking, or Powell was thinking of increasing the rate by 0.5 point.
Correct.
Right. Now we're hearing anywhere between 0 to 0.25. What do you think that means for mortgage rates in the next couple weeks?
I think if they come in on a lower basis, they come in maybe even the quarter or a pause, we're going to get a rally. Because again, it's kind of that celebratory, okay, all right, we're finally getting there. There's one economist out there I read that actually says a reduction. Okay.
Yeah, I heard that as well.
That's not going to happen. But
Yeah, no, I don't think
so.
I'm not putting money on that. But a pause completely, probably not. Probably the quarter, right? Because you're right, they were up at a half. Because I think you have two theories. One theory is, hey, we went in and solved the problem, so what are you worried about the bank for? We're going to keep pound until we get this inflation under control, which would basically mean a half, right? And I think that would send everybody into a pretty big shock.
But it can also be a slap in the face and say, look what we just caused, right?
Correct. And that's the other side of the fence is, okay, we know what we caused. We're going to back off a little bit. We're going to let this play out a little bit and see what happens. So to answering your question, I think if they come in cool enough, I think it will help mortgage rates.
Yeah. Let's go by what's probably going to happen, which is a quarter.
Mm-hmm.
That happens right now. We're at about 6.6, if I'm not mistaken.
Talking mortgage rates?
Yeah, 30
Sure,
year,
yeah.
30 year,
Mhm.
6.6 more or less. What do you think what do you think that goes to us? Just no one's going to hold you to this.
I don't know that a quarter would get that much traction. Yes, it would be obviously better than the half. I think if there was a pause on rates, I think we get a good half a percent run down to 6.1 or somewhere in that range. I really do. I kind of go back. We talked about this last time we got together of, where the 10-year coupon is. And I think today we're around 3.5, 3.6, and your normal spread there is about 2%, 5.5. We're right there, and to get into that range, if we can get the push that we need. The quarter may be, well, we expected that.
Yeah.
We're just going to kind of sit back. But if you get a pause, then I think you could push.
Now, how often does the Fed meet?
I think it's every 6 weeks.
Every 6 weeks?
Yeah, so they're meeting next on the 22nd.
Yeah.
Right.
So which is next week, and I think CPI comes out tomorrow.
Today. Came out today.
Came out today.
You know what it was?
Come out higher.
So it came out, I think it was lower than expectations, but the core, they strip out, I think, energy and food or something like that.
Mm-hmm.
The core went up, and that kind of freaked everybody out a little bit. Or I should say went up, sorry. It all goes up, but the core went
More than expected.
more than expected. That's the way to say it, yeah. And so that got everybody a little bit twisted up today. And the big driving factor in that is shelter costs, which is basically, rents and things. And those have come down. But the lag period, because of long leases and stuff like that, takes a while. So the information that I look into, I think we're coming up to that next month or two.
Do you listen to your uncles and neighbors and stuff like that?
Uncles, oh yeah, no. You know what? You don't want to do that. You don't want to do that. I know it's easy to do that, but you don't want to do that.
No, I'm messing around. So why is everyone talking about May 10th? What's going to happen May 10th that everyone's all...
Well, the projections are kind of... Well, that's another CPI reading. There's one April... I'm going to forget the date. But 14th, I think, or 13th. Anyway. But May 10th is where everyone feels like things start to line up, where the shelter costs do eventually have come
priced
down.
in, yeah.
Mm-hmm, exactly, and it was a kind of high number in the... So May 10th would be April reading of 23, and last year the April of 22 was pretty high. So it's kind of like, hey, we know we're coming under that. We think the shelter cost is going to come in. So then when you go to your core, so I think the word on the street there is from then on it should be a little easier to beat that inflation, to then back off the Fed and see mortgage rates drop.
Okay, so what for the people in the real estate industry, we keep hearing that the second half of this year is going to be a lot better. Obviously, that means more people buying, more people selling, more movement in the real estate market. Then you also have the people that are saying the market's about to crash, especially now being with this, this bank failure and stuff like that.
Sure.
But they're not comparing this anymore to 2008. Because
good.
Obviously it's a whole different year. It's a whole different thing, right? 2008, I kind of even get tired of talking about why the market crashed at that time.
Sure.
Very different scenarios now. Do you see any kind of downward market activity to where we can be worried about a crash in the next couple, maybe 6 to 18 months, more or less?
No, I don't. And I think, again, supply is a big issue. In fact, I think supply is what's keeping us from really taking off to where it really wants to go anyway. And if rates come down as expected, you're going to get even more demand. So I think supply is going to be the key there. And my projection would be, if rates do come down the way they're supposed to, that then some sellers calm down a little bit to sell as well and hopefully help the supply. The big factor in crash is in a huge abundance of supply, way over. And I got a realtor sitting right here. I'm sure he knows, but there's just not enough supply. And
You don't know much.
but he's good at data. I know
messing.
that. I know he's good at data.
So, Craig, so now just on that, obviously we do have an extremely low amount of inventory. I think, if all the houses stop putting on the market as of today, it probably lasts a little bit over 2 months.
Right.
So
Too much supply, yeah.
Yeah, but as far as new construction homes, have you heard of them slowing down or anything?
No,
or
they're speeding up.
speeding up. Okay.
Yeah, you are picking up on new construction, which I think is smart. I was just in another meeting earlier this morning. We talked about that, and I mean, of course, I think it's smart because the supply is not there, and people do want to buy. And as the rates come down, even more so.
I like to focus my well, they're not even local, but I like to focus kind of like my new construction info on D.R. Horton. They're a national builder.
Sure.
And they're probably building 70% of Bakersfield. Maybe that's not the number, but I'm just saying you see them everywhere. Mm-hmm. You see them in a lot of the Southwest. And to my point, is they're a national builder. I'm sure they have somebody that knows what they're doing.
They have a good idea of what's going on.
I'm sure they know what they're doing.
for sure.
And if they're still building and they're not giving very many incentives anymore, that can mean something to the day-to-day person, right? I think too many people get stuck, and I think it's crazy to see it happen. But many people who don't own any homes, don't own any investments, maybe crypto, stuff like that. Getting too far stuck on like this, Silicon Valley Bank just failed, and this just happened, and the Fed rate, and this and this and that. Like my advice to first time buyers and to buyers in general who aren't real big time investors buying $1 million, properties, like stick to the local, stick to what's happening locally.
Sure.
If the builder's still building, that might be a sign of the market not going anywhere, right?
Yeah.
What's your take on that?
Well, I think, one, and I don't know the exact numbers, but the builder sentiment was higher recently the first time in months and months, meaning they're saying, hey, you know what? This is looking better. We're getting better traffic. We're getting more people in here. So I think that part is good. And the builders, know that. But I think, people that, like you mentioned, don't own a home, don't, and see a crash like this and think, oh, here we go. Honestly, in my opinion, it's no different than, there was a shooting in Atlanta and now we're worried we're going to get shot here. I mean, yeah, it can happen. I mean, anything can happen.
Boom. I like that.
I mean, anything can happen. I mean, we all know anything can happen.
Yeah,
but I
and
think
it's great to be like skeptical about it, right? But of course, do your research, get your information from the right people.
I mean, if you want to, my point is, if you want to find the negative, you're going to find negative. You're going to find negative in anything. Yeah, exactly. So you have to look at the overall picture. And I think just in simple terms, you don't have to be an analyst. Just in simple terms, real estate goes up over time. We probably talked about that last time. That's just simple terms. Tax rates go up every year. Why do they go up every year? Because they know the value goes up every year. And so, just in simple terms, getting invested into a home is a smart decision over the long period. You can always pick things apart, and it might be this or it might be that, but I don't think that ever gets away from.
Now, they say history repeats itself, and we're far by due for some type of market failure or economy crash. What's your take on that as well?
Well, I still go back to the same thing, which is, a lot of things could be happening all around you, but you, for your own personal wealth and your own personal gain, should own a home, period. I mean, if you have to start somewhere, and owning a home is the start. I can't remember the stats, but I saw an article one time. It was like, of all the, millionaire or above or whatever, I mean, that's the number one thing in common is owning real estate. Yeah, exactly. Because it's the easiest way to get to wealth. So my question back to, just an everyday person would be, what is your other plan? Where does your other, if you're not going to buy a house because it's going to crash, what are you going to do to gain wealth? Gold sword. Gold. I know, right?
No, hey, no.
Gold sword.
But seriously, I've heard people tell me that they're just going to stick to gold.
Okay, great point. So here's my thing. You're going to put how much money in gold, okay? Let's use the example of buying a house. You're going to buy a house. Maybe it costs you $10,000 to get into it. Okay, so you're going to go buy $10,000 worth of gold. Good for you. And it goes up. Goes up what? I don't know, 10%, 20%, 50. Okay, what'd you make? $2,000, $3,000, okay? Turn around on a house, and over 5 or 10 years, if that house went up 10 or 15%, now you're talking 30, 40, 50,000 for your same $10,000 investment. I'm sorry, it just doesn't pencil out. Doesn't pencil out.
Yeah, and like we know, gold and silver are more like a hedge, I guess. And
correct.
People say against
hedge against
inflation,
cash and stuff like that. Yeah,
yeah, of course.
Yeah, but it's not. That would be my thing to a customer. I understand the concerns, but if you want to build wealth for you and your family, what better measure to get started than a home? I don't know of any other.
And that's the easiest. You can get in with little to no money.
Exactly. They can't make it any easier. I mean, 20 years ago, it wasn't that easy. You had to have the big down payment. And you had to have everything perfect. You had to have all the I's dotted, T's crossed, debt ratio way low. They've made it so easy. Why wouldn't you take advantage of it? It just blows my mind, to be honest.
So, I mean, on that same topic, what's your thoughts? Obviously, I have really good opinions about it, but what's your thoughts on that Dream for All program? That I believe it's in line with CalHFA, right?
Well, as we're moving into that real quick, I wanted to ask you something kind of along the lines of what we were talking about, and then we'll move into that real fast. But So I myself, I had this conversation with somebody recently, and I said, like myself, I'm in the business, right? So I tend to be very optimistic about it, right?
Sure.
This just happens. Well, yeah, but and obviously try to see. Do you feel like you're the same way, or are you 100% like data shows this, so whatever, it is what it is?
I would hope that I am more data driven than emotional about it. And I think that's just because what I have been through. I always fell on the optimistic side when I was younger. Like no matter what it was, I'm like, oh, it's no problem. Oh, it's going to be fine. Oh, it's going to change tomorrow. But I've grown to be more data driven and let the numbers tell me what they're telling me. And everything that I'm answering today, I think, is based on that.
So it's not really emotional, almost at all.
Not at all. No, not at all. I mean, again, I couldn't come in here and say how things are great if you could simply see by the numbers telling you it's going to crash tomorrow.
Yeah,
100%.
Yeah, that's all I want to know is because my opinion on all this stuff is obviously based off data and facts.
Sure.
But I still put my optimism to it, like in the sense of like, but this happens, but how much of it can I control? So what I could control, I'm gonna control, right? Yeah. But then there's those people that are like, yeah, but the conspiracies. Like,
I don't decline that we're in a strange environment, and I don't I'm not saying everything's booming or anything like that. I'm just saying in terms of crash, or in terms of this bank going out of business affecting us in Kern County, and all of a sudden my house and your house all just went in half value. No, I don't buy that at all. And I think anyone that feels that way, to help them, not to debate with them, to help them. Why do you feel that? What data are you looking at? What reason do you believe that to happen, so that they can try to understand it? Because honestly, it is complicated. And so, if you're, the everyday kind of person, you're not in this industry, you're not in a professional, in that industry, I think it's tough to understand. So what information do you have to why you feel that way?
Yeah, and let's help understand each other, right?
I did a webinar thing the other day that I was watching, and, it was like questions asking buyers and things like that. And that's one of the questions, is how do you feel about it, and why, I mean, what are your goals for it? And I think if you start to go into that direction, maybe you discover something that's very real for them, or maybe they discover that it's not very real, and then the fear's behind them.
Yeah, 100%. So this Dream for All program that have you taken a further dive into it recently from what we've talked about in the past?
I mean, I think I got a pretty good gist of it. Yeah.
So from what I'm hearing, Hilda just said 700. Million. I read 500. He read 300
million.
Yeah. So just know it's a lot of millions, right? We'll find out the exact number. But
that's a lot when you're only talking 10 grand or 20 grand, 30 grand.
I mean, regardless, though, it's still limited, right? So please take advantage of it, right?
Oh, absolutely, take advantage of it.
Yeah, 100%. It's limited. Take advantage of it as soon as possible. What I did hear that did correlate with what Hilda heard was that it's going to be around for about a year. Then it's going to take about a 6-month pause because they need to recycle the funds.
Sure.
And then after that, it should be a program that's around kind of like just regular Caja right now.
Sure.
And so that being said, can you kind of give us a brief little overview of what this program is and how it works?
Yeah, so it's basically an 80-20, and some people might think, oh man, 80-20, that's bad. Well, that, again, long time ago, different scenario. But it's basically an 80-20 where you got an 80% first mortgage, a 20% second mortgage. The 20% has no interest and it has no payments on it. So you're only paying on the first mortgage 80%. The thing I love about it right off the bat is that means no MI. So you already reduced the cost of a house right off the bat. Now, how much depends on, a lot of factors, but you save at least, what do you think, Edgar? I don't know, 150 maybe?
Yeah, I was going to say about, with today's prices, probably like $175, $200.
Yeah, so I mean, you're saving a couple $100 right off the bat. Right,
just PMI alone, you're saying,
just
right?
Just PMI alone, right out the gate, which I think is awesome. 0 down payment. So you're not 97, which is 3% down. You're not 96.5%, 3.5%. 0 down, right? You got closing costs. So we're not trying to mislead people. You just have some money to take care of. But no down payment, no MI. To me, you can't beat that, right? So,
and just to second you on that, if you didn't have money and you wanted to use 3% of that to cover your closing costs,
is that option?
You can do so, right? But you now pay MI, if I'm not mistaken.
I don't know if I'm following you on that.
Yeah,
So,
so
the
instead of
20%
using
you
the
can
entire
use, for
20%.
example, 15% down, 5%.
okay. Oh, okay.
You know what I mean? Like
Yeah.
the max
Right.
combined loan to value is 105.
Right.
Meaning that if you wanted to, and I say 17 because you technically can't use more than 3% for the
3%
down payment or whatever.
Right,
but
right.
so if you essentially come out of pocket nothing,
Right.
you just pay MI now.
Sure.
And MI off of 85% LTV is still not crazy.
Sure. No, you're
So,
absolutely
so
right.
you're still going to
absolutely
have
right.
like a what, maybe $30, $40 monthly MI
Sure,
if you have
sure.
good credit.
Sure,
you know.
sure.
And so obviously, if you're just at the 680 that the program requires for the MI to come off, and you go with MI, well, obviously you're going to have a higher MI than someone that has 780, right?
Sure.
And MI, for the people that don't know, is mortgage insurance. So it's pretty much the way that the bank backs itself up
Right.
from you making your payments. But anyway, what I was saying is you can go that route as well, right? Like
can.
17% down payment, 3%
I
for
think
closing
I
costs.
believe you can.
Yeah,
believe
because
you
it says in any combination.
You're right, any combination. That's
Yeah.
right. I think it's a great program. You know, some of the feedback we've gotten is because the way it works is when you pay off the loan, refi or sell, that 20% that you borrowed from the bank, if it's 20% that you borrowed from the bank, has to be repaid with a 20% appreciation of the value. So then people, oh man, there's the catch right there, you know. And it's like, well, I mean, let's do the math. I mean, you know, say you bought a home for $400,000, right? And your 20% is 80, okay, and then you go to sell it a few years later, and it's worth it's worth 500,000, so it's went up 100. So you would owe 80 plus 20 grand of the appreciation. So you
owe them 100 grand.
You owe them 100.
You keep 80.
You just made 80 with zero down payment.
Exactly.
I'm not sure what there's to complain about that. And if you didn't sell and you just kind of say, hey, I'm going to just stay here kind of forever, well, then you don't pay it back.
Well, the alternative to that is save up your 80 grand yourself, right?
Well, that goes back to my
Yeah,
point.
save up your own money.
It goes back to my point. If you're going to start today with 5,000 or 10,000 or whatever, and you want it to go to 80, what's your plan? There's
Yeah.
you know, there's some illegal
And then-
things, I guess, but
and the thing is too that what's really important to me is we all know one of the biggest struggles here locally is qualification for the minimum for the average median sales price, right?
Sure.
And so, you know, you'll get a buyer who's, oh, hey, this person's qualified for 220, but the median sales price is 375, right? So that's where it gets
well,
tough.
I think they should be thankful they're in Kern County and not LA County or
Right.
Ventura County, because it's 10 times worse there.
Well, what I was getting at with this was that, like, okay, you're, like we said from the get-go, your payment and DTI are based off the 80%,
correct.
right? With no MI. So
Correct.
essentially that 20% is
You have
saving
more buying power.
saving you about $400 a month.
Yeah, you have more buying power.
So now if you were qualified for 200,
Right.
you're qualified for 300.
Right.
You know?
No, absolutely.
Yeah, and then
Absolutely.
if I'm not mistaken, it goes based off of the lowest CalHFA rate, right?
You know, Edgar asked me what I know about the program. He knows
Right.
you don't need me on here to do this. I mean, you know everything about
There's a
this.
Q&A for Craig.
I want
Edgar. Come on.
reassurance. I want reassurance.
Q&A for Craig.
No. It's good. It's good.
One thing I do have a question about that I haven't been able to get the correct. Well, maybe I did get the correct answer, but is this only a only a conventional option?
You know what? I'm not 100% sure on that.
From what I had read, and this wasn't off
Yeah,
CalHFA,
yeah.
so I can't tell you.
Yeah.
So what I had read or saw a video about was that you can go FHA,
I think you can,
but you
I'm-
pay MI.
Right. I think you can. I'm not 100%, but I believe you can. The drawback would be some of the benefits are gone if, you know, you are paying MI and stuff like that. But qualifying is a little easier for FHA. So
Exactly. That's
But
what I
I
was
don't
going to
know.
say.
I don't know that for sure.
For someone that's at a 680 though, even if they qualify for the conventional option,
Right.
the interest rate's higher.
Sure.
And the MI, if you're at a 680, might be 0.55 anyway,
Sure.
right? So,
Well, yeah, FHA dropping its MI. That's
Exactly.
another big,
Exactly.
That's another big thing out there in the market that I think is helping a lot.
it's
of
almost
people.
by half.
It dropped by 35%, right? The PMI.
Yeah.
Yeah, so it's a big jump. That's a big jump.
Yeah,
Yeah.
I think the important part of this program
30%.
is just 30%. It just so this program allows you to like get in the game of real estate, right? And then it allows you to now reap the benefits of appreciation, building equity. And people take that as like, giving 20% at the end of the day when they refinance or sell. But they're allowing you to get in the game and then now reap those benefits of the other 80% of appreciation that you're going to keep.
Yeah, I think if you look at what is the problem, right? So if you're Cal Haffa as an agency and you're sitting around the boardroom and you're going, hey, how can we help people? The number one problem was qualifying, affordability.
Yeah.
Okay, so they came out and said, we'll help solve that a little bit. You have no payment on the second. It's only an 80% first. So they kind of solved the affordability problem. So my thing right off the bat is, if that was your concern as affordability, then that kind of got taken off the table with this, type of a program. So I think that's the biggest part of it. And if you were to go and buy a house, any investment property or whatever it is, and you had an investor that was going to front you the money, they're going to want something back.
Yep.
And if all they want is 20% of the equity, sorry, not the equity, the appreciation, right, way down the road, and hey, you know what? I'll wait 10 for you. I'll wait 20 years for you.
25.
I would take that deal from an investor all day long. To me, I think it's an absolute steal for a client to do it.
Leveraging your money. No money, right?
Yeah, what do you have?
Investors' money, you're saying, right?
Yeah, this is OPM, right? Other people's money. So why? To me, what if you get a seller that is willing to help with some closing costs, and you virtually got in with nothing, and now you're just sitting back and letting it appreciate. Tax deductions, all that stuff now have just implemented, and you haven't done anything. Or do you want to go buy a gold bar? I don't know. It's up to you.
Yeah. So all your objections, with the high interest rates, no money down, or like not enough money to put for a down payment, those are out the window with
And
this program.
affordability.
And affordability.
Right. And those were the things I think that the struggle was in 22. So to me, it's brilliant that they come up with it because it attacks where the problems are. And the people, that can be pessimistic go to I got to share that. You didn't put anything hardly in to begin with. You should be thankful they don't want 50% of it.
Yeah, like I said, and then at the end of the day, the people that do think that way, then go save up your 20%.
And some of the right, correct. It's like, well, then put your down payment. But some of the comments have been, if you kind of foresee some of the values going up and that kind of thing. No one's saying you have to stay in it forever. You can refi right off the bat.
I've said that too. So you technically can refinance it in 2 years where your appreciation is minimal,
right? And
you give them 20% of nothing.
Yeah, maybe it's only $5,000 that you had to give them, or whatever the case is, and now you can enjoy 100% of the appreciation forever. So the flexibility is all yours, which I think is super important too. That people might not be catching on that.
And the reason that makes sense for example, so like if a homeowner, once he reaches a certain percent of appreciation, he can now refinance or sell, right?
Yeah.
And like the reason it makes sense for these investors and like these mortgage companies that are providing this this program is because for them it's just a like a quicker return on their investment, right? Is that why it completely makes sense for them on the investor side? Well,
Cal Haffa is sponsored by the state of California.
Okay.
Yeah. So Cal Haffa, if everybody doesn't know, is subsidized lending for lower income first time buyer, individuals. It's not made for your $1 million, guy that's bought. I know, Edgar, you're out.
Damn.
But so it is subsidized. Cal Haffa is subsidized, but they're simply taking this 20% investment, and with the appreciation when they get paid off down the road, they're recycling the funds, kind of like what Edgar was talking about. So their hope is to grow the pool of funds, not really for profit, but just to do this more and more and more in the future. So, hopefully it happens.
So, would you be surprised if this program lasts more than a year? Like, do you actually see the longevity in the program? Because for me, I was thinking more like of short term, like the equity builders.
I think short term because it's going to be popular. Exactly. It's going to go quick.
The funds are going to go
and then it's not going to get paid off super fast, right? People do pay off, but it would be some time. So I don't know, man. Again, if I'm on the pessimist side on this, I apologize, but I kind of think it's going to go quick. So I would
urgency.
I agree.
I would jump in, and then when it pauses, I don't know it's going to be back soon. Not because it's gone, because they do have to replenish the funds.
Yeah, so it's not like they're gonna. So they're putting $500 million into this program, $300 million, whatever it is, and they run out of funds. And then people start to refi and sell. It's going to take a while to get their $300 million back to keep going.
Or to the point where they could at least offer it again.
Because they can't offer and then, oh, wait, hold on. We ran out again.
Right.
And then, all right, we got 2 more loans. Wait, we ran out again. So they have to, when they re-offer it, it has to be a thing where it's like, okay, we can kind of.
Substantial.
Yeah, we can go.
Honestly, I've been doing this a long time and I've seen Cal Haffa come in, come out, come in, come out sometimes in different programs. It happens, because they are raising the funds. But I do think it's going to go quick. I think it's going to be a hot commodity when it hits. It could be coupled with better rates, which would be even better. It hopefully could be coupled with some more inventory.
Think about a time where you get this program and rates drop down to 5.75%. Man, we're gonna be living in glory.
Well, I mean, the analysts are thinking lower than that. So, we'll see. We don't want to quote too much, but we definitely see it getting down there. And if it all couples together, funds are going to be gone. I'd highly recommend getting in quickly to try to do that.
Yeah, my advice to everybody is get approved now. And then, realistically, if you qualify without the program, start submitting offers. By the time you get one accepted, this program rolls out. We switch you programs. Boom, you're good to go.
Yeah. We have several like that now.
Yeah. So
because we did the math, right? I think out of that 300 million, we did the math. It was like maybe like 5,000 to like 6,000 families.
Yes, it's going to go fast.
Yeah,
and
so
that's
5,000 all of
5,000
California.
Yeah, that's 5,000 families in all of California.
Well, the advantage to that part is, again, A, first time buyer, right? And then B, you can't make too much. So, in some of these higher end counties, or areas, San Diego, San Francisco,
The Bay
LA,
Areas.
it might not be as popular as it will be here. Like, let's take advantage of our county to this program, and let's do some good.
And then and then a lot of people have to take into consideration too that people are moving to our county, like a lot, right? And so these people probably are doing it for the same reason as well. You have a family in Santa Maria who, they make the average income in California of these kind of counties, but they can't afford anything over there.
Sure.
So they come find a job and move out here. So, you're here, you have the advantage, and take advantage of it.
100%.
Yeah.
Any other thoughts, Adrian?
What's the county limit for Bakersfield? Because I know it goes based off the county limit.
The sales price or the income?
Yeah, income county limit.
Oh, okay, income. So, do you know that?
I don't. I think
I know.
it's 140.
Yeah, I know. 2 years ago. Oh, no, last year. I'm sorry. Was 130 something. It was like 130 something. So it should have gone up when they moved it in November.
It's enough to buy a house in Bakersfield. Let's put it that way.
And if you make more than that, you probably should have a little bit of money sitting.
Yeah.
So when do you foresee going rates down to 5%?
Well, I'm kind of in line with this May 10th thing. Like Edgar said, I think second half of the year. We got better rates yesterday. There's other reports coming out. We got the Fed meeting next week. All kinds of things can happen to where we start to see some better rates. But I think more on a consistent basis, maybe a quicker, rapid basis, second half of the year.
Did you see Kennedy kind of go at it with Jerome
President?
Powell? No. No, he's like Senator Kennedy. But I think he was like going like in an exchange with Jerome Powell.
Yeah,
he
like
was
the Congress testimonies and stuff.
No. He was just pretty much talking to him like if for example, for inflation to start coming down, we need to see unemployment up to like 7 or 10%.
He pretty much told them, you want people to get unemployed.
Yeah, you want people to get
that's
unemployed.
what you want.
He does.
That's what you're
and
doing.
he pretty much says,
Yeah, he does. Yeah,
Like
I do.
very, very straight up. Like very, like that's
I know.
no matter what, we're gonna do that. So now, hopefully, with this and with Silicon Valley Bank, now everyone's kind of, has that same perception as you that they are gonna start slowing down.
Hoping, yeah.
And that means good things for interest rates.
You,
for interest rates.
not political question at all. You like the guy for his job?
Powell?
Yeah.
Where do you rate him at 1 to 10? How his performance is so far?
Oh man, that's tough. I mean, I'm probably not big.
He won't find out that you.
I'm probably. I know, right? I'm probably there. Yeah, he's on the phone.
Imagine he does it next week. Just,
I know. I'm gonna. I mean, I would say probably somewhere in the middle. I don't. I mean, I definitely. I get where he's coming from. Okay, I do. It's just that one of the things that I do 100% agree with is, when you're an entrepreneur, you're a business person, you're out in the real world, you're killing to eat every day. You do have a different perspective than a Harvard degree economist. I don't know if he went to Harvard. I don't mean that. What I mean is he's an economist. His background is more, on theory, and instead of real world. And I think that's probably the disconnect there. I think he could be better at understanding that inflicting that much pain could then turn around and kill everything
to the everyday person.
But it's kind of like if I have a job and you have a job and I'm going to do my job the best, even though it's going to kill your job. But I don't care because that's your job.
Yeah, that's your problem.
I can at least say, hey, I did my part.
Yeah.
But if you look at the teamwork aspect of it, right, you're killing the team here. You just killed a bank. You're killing everything. Yeah, but I'm killing inflation.
Yeah.
So it's like, I think that's kind of the stance is I'm good at what I'm doing and I don't care what everybody else is doing. And it's kind of like, it doesn't really work that way.
together.
Yeah,
I definitely feel like that's one of the most toughest and like criticized jobs, right? Because like you said, no matter what he does, it's good for one side, bad for the other. Or it's not good for either.
I will say, I think I kind of feel bad now because now you really got, I mean, you got the bank crashing over here, and what are you going to do about it? And then you got inflation really isn't under control. What are you going to do about it? And hey, unemployment could be getting out of hand. What are you doing about it? So they got a tough road, but again, I think I don't even know if they have advisors or they just talk to each other or what. I don't know. But I do think if they did have advisors in real world, it's like, man, you better be careful. You got to cool down a little bit.
Yeah, I do think we need like younger people in those positions. Or I don't know, at least like Jenna Yellen and stuff like that. Yeah, we need younger people in there.
You wonder sometimes some of the comments they make. You know, it's kind of like, what in the heck?
Yep.
So out of touch, right?
A little bit, but I think that's what happens when you're behind closed doors. You know, when you're out in the real world and you're trying to make it, then you kind of get a better feel.
Yep. Well, if any of you guys have any questions or want Craig to come back, go ahead and comment on here. And
Craig's a natural. Craig is a natural.
We said we were going to make it short. We can never make it short, Craig. We can never make it short.
We're sort of short.
We're 45 minutes.
Okay. Cut it.
Yeah, last time was 2 hours. All right, guys. Thank you guys for watching. Make sure to subscribe and follow us on Instagram.